let's have another look at X. Perhaps he's unhappy with all the stares he's attracting by not wearing any clothes and such, and therefore he wants to buy himself a house with all the money he has. Notice how he would turn illiquid and would not be able to repay even the smallest liability if he had one, even though he's in excellent financial health. Now, instead of $100,000, he has a house worth an equal amount. His leverage is still 1-to-1. Now let us assume that for some reason real estate goes up in price by 50%. What happens to X's balance then? Assuming that his house appreciates along with the market, his new balance looks like this. His equity rose along with his assets by 50%. He is 50% wealthier than before. Similarly, if we assume that the market goes down by 50% and X's house along with it, he lost 50% of his equity. His wealth has been cut in half. So, 1-to-1 leverage means that your equity moves in tandem with your assets. A 1% increase in assets leads to a 1% increase in equity, and vice versa. Let's assume that X wants a nicer house than the one he can buy with $100,000. He therefore borrows an additional $200,000 to buy a house worth $300,000. His balance then looks like this. His leverage is now 3-to-1, $300,000 in assets and $100,000 in equity. In the scenario where his house appreciates by 50%, its price rises by $150,000, increasing his equity by 150%, from $100,000 to $250,000, an impressive return. But what happens if the market goes down by 50%? Then his house depreciates to $150,000, while his liabilities still amount to $200,000. He has become insolvent. His equity shrank by 150% to minus $50,000. So 3-to-1 leverage causes equity to move by 3% for every 1% move of the assets. That means that with 2-to-1 leverage, a 50% move can wipe you out. With 3-to-1 leverage, a 33% move can wipe you out. With 10-to-1 leverage, a 10% move can wipe you out, and so forth. In light of the fact that European banks, based on their balance sheets, currently have an average leverage of about 25-to-1, meaning a 4% move in their assets would wipe them out, it is easy to understand why the financial system is often regarded as unstable, especially when considering that those banks are not independent entities that stand and fall on their own, but are intricately interacting with other banks, like dominoes, that might not be lined up directly, but are standing in close proximity, so that toppling a single piece can lead to unpredictable consequences. On the other hand, while 4% might not sound like much on a relative basis, it is a very large amount of money in absolute terms. Now that we have a basic understanding of what a balance is, I want to point out one of its most fundamental problems. Since the idea of a balance is to list all assets and liabilities and their respective values at a certain point in time, the fundamental question is, how does one come up with cash values for the various items of a balance? For some items, the answer is straightforward. For instance, cash has a face value. Also, any debt that was taken on has to be repaid in full. But what about items that do not have such a face value? In this case, the agreed upon principle is called mark-to-market. This means finding out what has recently been paid for an equivalent item and assuming that one could sell for the same price. For example, any stocks or commodities can be valued in that way because they are fungible, and it is very likely that one could find another buyer who is willing to buy for a similar price. But this assumption is actually only reasonable if one has only small amounts of such assets, because if one were to sell larger amounts, especially in a short time frame, the market would go down considerably due to the sudden increase in supply, and therefore one would actually receive less money than mark-to-market would suggest. But this is only the tip of the iceberg. What do you do if there is no equivalent item on the market? For example, what is the market value of a specific house that was bought several years ago? You don't know its actual price until it has been sold again. So what amount does one put in the balance sheet? If there are similar houses in the neighborhood, one can try to infer its price by investigating how much those similar homes were sold for recently. But this is only an approximation. What if the last house has also been sold several years ago? What if all houses in the neighborhood differ in some important aspect, like size, architecture, layout, view, proximity of public transport, etc.? Similar problems are encountered when trying to estimate the value of loans that a bank has granted. If, for example, a bank can expect someone to default on its mortgage, putting the loan with its full value in the balance sheet would be a misrepresentation. But what is the correct value then, and how does one acquire it? Here, mark-to-model comes into play. The idea is to create a typically complex statistical model to come up with a number. Sometimes, for lack of a better estimate, the original value is kept in the books. Either way, those numbers have to be treated with a large amount of caution and suspicion. People critical of such accounting practices are therefore often calling them mark-to-make-believe, or mark-to-myth, instead of mark-to-model. And with good reason. One can use such accounting techniques to create imaginary profits. Imagine you acquire several assets that are difficult to mark to market. You start trying to resell them for a higher price to turn a profit. The ones you cannot sell for a better price stay on your balance, perhaps for their original price, even though they might have fallen in value. So, as long as you aren't forced to sell those assets to determine their actual market value, you are able to turn up profits while hiding potential losses. What you should take away from this is that in reality a balance is not an exact scientific construct, but a, hopefully honest and educated, guesstimate. It is a very useful tool to think about financial transactions though. So, let us return to our previous example of X buying a house. In the second example, X took on a loan of $200,000 to achieve his 3-to-1 leverage. One way for X to acquire this loan would be to ask a wealthy friend, in this example F, to lend him the money. If F were to do so, he would give his asset of $200,000 in cash to X, but receive a new asset, a claim of $200,000 from X. Conversely, X gains the cash, but also a new liability to F of the same amount. Now, X can use this total of $300,000 to buy the house from the seller. Now, what can X do if he does not have such a rich friend? Let's imagine X lives in a town where a new bank has just opened. Perhaps the bank used all of its initial cash to buy a nice, big and safe vault. X might have been somewhat uneasy having all his money at home, so he seizes the opportunity to open a checking account and deposits all his cash with the bank. He's being told that he can get his money back whenever he wants. Knowing that banks also offer loans, he asks for a mortgage loan of $200,000 to buy the house of person S for $300,000, making a 33% down payment in the process. What do you expect the bank to answer? Can they even say yes? You might find the answer shocking or hard to believe, but the bank really answers in the affirmative. How can they do it? Well, they simply add $200,000 to X's account. After all, accounts are just numbers in a computer somewhere. Doing so, they incur a new liability of said $200,000, but at the same time they also gain a new asset, X's promise to pay them back with interest. Now, how can X pay S for the house with his newfound fortunes? Well, if he were to ask the bank for the money in cash, it could obviously not pay him. But to the bank's good fortune, X is very unlikely to do so, since he has a far more convenient way. He can write a check to credit S. As instructed by X's check, the bank can then simply move the claim of $300,000 from X's checking account to S's. Notice how no real money was actually moved in this transaction. The bank just had to change a few numbers in their books, or, more accurately, their computers. After this transaction, S really thinks he owns $300,000. In a very real sense, the bank has created new money, practically out of thin air. Granted, this example is rather artificial, but the principle holds true. This process describes how banks conduct their business. If you have never heard this before, you're probably confused. Don't worry, so was I, and apparently a lot of other people as well. John Kenneth Galbraith, a famous economist who taught economics at Harvard and was a presidential advisor to several US presidents, put it that way. The process by which money is created is so simple that the mind is repelled. To understand more clearly what is going on here, an abridged account of the evolution of money and banking should help shed some light on the issue. Long before paper or even gold money was used, and even before the concept of money was discovered at all, people bartered to acquire the goods and services they needed and desired. But barter was often very tedious due to the so-called double coincidence of wants problem, meaning that for a transaction to occur, both sides had to offer some good that the other side wanted. For example, if someone had an apple and wanted an orange, he had to find someone else who not only had oranges, but also wanted apples. On top of that, his trading partner had to be willing to agree to an acceptable exchange rate, but since goods were not priced in money, it was hard to compare deals. So even everyday transactions were very cumbersome, and larger transactions in such a way were all but impossible. So, how did most transactions work if direct barter of goods was often difficult? Well, by going into debt, of course. Even though we typically think about debt in terms of money nowadays, debt can just as well be denominated in goods or services. Or it can even be left unspecified, therefore relying on the fairness of the debtor that he or she will adequately compensate the creditor in the future. So people often traded by exchanging goods and services for promises and favors. This of course meant that trust and personal reputation played a key role in all transactions that involved some kind of promise and weren't just a direct exchange of actual goods and services. But trust and reputation are, at least at first, only feasible on a small scale. So while promises might have worked quite well for minor transactions in everyday life, major transactions or transactions with unfamiliar parties were still very tricky. But over time, some people realized that some goods were desired by a larger part of the community, and so they began accepting those goods as payment, even if they did not have an immediate use for them themselves, because it was safe to assume that they would be able to trade those goods for something else in the future. This created a self-reinforcing cycle, because now those goods were desired by an even larger group of people, making them even more useful for trading. It also created a winner-takes-all dynamic, because a more broadly accepted good was preferred over a less broadly accepted one, making the former even more desirable and the latter a bit less desirable. These are just a few of the mechanics that over time gave rise to the concept of money.